Hey there, Ryan Black, real estate investor here, and in today's 2-minute investing tip, I want to talk to you about the importance of continually running your numbers, particularly when you're dealing with a rental property. So we have a rental property, a sixplex that we bought a while back, and when we purchased it, it was not performing. Okay, it was not performing. It was in bad shape. And a lot of times people, when they think of fix and flips, they think of a single family residence. The thing is you can fix and flip apartment complexes too. And that's basically what we did. We turned it around, we increased the NOI, the net operating income, significantly, and we nearly doubled it. And so now when you're looking at doing the analysis of what that property is worth, multifamily properties, particularly commercial properties, you're buying and selling that based off of performance off the NOI. So in a very short period of time, we've increased what we could sell that property for by about $150,000, right? And we've been receiving the cash flow from that property as we've owned it. And if we chose to continue with that property, well, we'll continue to receive phenomenal cash flow from that property. But the reason that I want to talk about continually analyzing is if you have a property that you own, that you're flipping, or you're just having in your rental portfolio, you want to constantly be analyzing it because things change. Whether you're actively improving the property like we did, and or if it's just subtle market changes that are happening, you want to be aware of what your equity is doing that's in that property and what the market is doing, because while you may even be receiving great cash flow from that rental, look and see, if I were to sell this and cash out, what would I be able to do with that? You might be able to, like in our case, turn around and sell that and take that $150,000 in equity that we would be walking away with and reinvest that into another property that can perform even higher. So some people tend to, once they acquire property, they think it's one and done, and they kind of sit on their laurels a little bit and say, oh, well, my manager's running things and it's performing, we're getting cash flow, I'm not worried about it, it's a long-term investment. Granted, rentals are long-term investments and it's a different strategy, but just keep that in mind. If you have properties in your portfolio, make sure that you're constantly going back, or maybe not constantly, but regularly going back and looking through, whether that's quarterly, whether that's biannually, whatever it is, going through and figuring out, am I getting the best performance for my money on this deal? And if not, what do I need to transfer it into in order to increase that performance and get a higher ROI?